Hi friends, good day. Today let us try to understand about stock market index, valuation of stock market index, criteria for selecting stocks to the index, notable indices of Indian stock market, and common stock market indices through this video. According to Warren Buffett, games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard.
Please subscribe for more videos. Click the bell icon for updates.
What is stock market index? Stock market index is a measure which shows the changes taking place in the stock market. It helps the investors in comparing the current price levels with the past prices to calculate the market performance. It gives insight into the overall trends in the capital markets and sentiment of the investor towards a particular stock or a set of stocks in the industry. It acts like a barometer which shows the overall condition of the market. This facilitates the investors in identifying the general pattern in the market. Let's look into the formation of index. Few similar kinds of stocks are chosen from the securities already listed on the exchange and are grouped together to form the index. The criteria of stock selection could be the type of industry, market capitalization, or the size of the company. Valuation of stock market index. The value of the stock market index is computed using values of the selected stocks. Any change taking place in the selected stock prices impact the overall value of the index. If the prices of most of the selected securities rise, then the index will rise and vice versa. Some of the notable indices in India are as follows. Number 1. Benchmark indices like NSE, Nifty and BSE SENSEX. Number 2. Broad-based indices like Nifty 50 and BSE 100. Number 3. Indices based on market capitalization like the BSE Small Cap and BSE Mid Cap. Number 4. Sectoral indices like Nifty FMCG Index and CNX IT. For instance, the S&P BSE SENSEX, that is Standards and Poor's Bombay Stock Exchange Sensitive Index, also called the BSE 30 or simply the SENSEX, is a stock market index of 30 well-established and financially sound companies listed on the Bombay Stock Exchange, that is BSE. Similarly, the Nifty 50 is an index of 50 companies listed on National Stock Exchange, NSE. So each index has its own calculation methodology and usually is expressed in terms of change from a base value. Thus, it is a tool used by investors and financial managers to describe the market and to compare the returns on specific investments. For instance, on 1st January 2018, the value of SENSEX is at 33,500 and on the next working day it becomes 33,600. From this statement, one thing is obvious. The overall performance of the stocks of the companies reflected by the SENSEX index has improved on the next working day. But it does not necessarily mean that the stocks of each of the 30 companies performed better than yesterday. Some of them performed better and perhaps some did not. But if we consider those 30 companies as a single company, then the stocks of the hypothetical single company performed better than the previous day. The two most commonly used stock market indices are A. Market cap weightage, B. Price weightage. We will look into market cap weightage. Market capitalization refers to the total market value of the stock of a company. It is calculated by multiplying the total number of outstanding stocks floated by the company with the share price of the stock. It therefore considers both the price as well as the size of the stock. In an index which uses market cap weightage, the stocks are assigned weightage based on their market capitalization as compared to the total market capitalization of the index. Suppose a stock has a market capitalization of rupees 50,000, whereas the selected index has a total market cap of rupees 1 lakh. Thus, the weightage given to the stock will be 50%. It is important to note that market capitalization of a stock changes every day with the fluctuation in its price. Due to this reason, weightage of the stock would change daily. But usually such a change is marginal in nature. Moreover, the companies with higher market caps get more importance in this method. In India, free-floating market capitalization is used by most of the indices. Here, the total number of shares listed by a company is not used to compute market capitalization. Instead, uses only the number of shares available for trading publicly. Consequently, it gives a smaller number than the market capitalization. Now the other method, price weightage. In this method, the value of an index value is computed based on the stock price of a company rather than the market capitalization. Thus, the stocks which have higher prices receive greater weightages in the index as compared to the stocks which have lower prices. This method has been used in the Dow Jones Industrial Average in the US and the Nikkei 225 in Japan. Well, thank you so much for watching. Please like this video and do share.